Hello, I'm Kyle Caldwell, and this is On the Money, a weekly look how to get the best out of your savings and investments. In our last episode of 2024, before we return in the new year, I'm joined by Richard Hunter, Head of Markets at Interactive Investor, to look back at the investment predictions made at the start of the year. So each year, Richard comes up with an investment acronym that highlights the key things for investors to watch over the year. And for 2024, the acronym was maturity. So I'll start off by spelling it out, and then we'll take each letter in turn. So it was M&A, AI, turbulence, UK market, recession, inflation, technologies, Magnificent Seven, and yields. So Richard, let's take it from the top. M&A. So this was based on the prediction you made that there would be a pickup in merger and acquisition activity in 2024. This has certainly played out. Could you run our listeners through some examples of UK listed companies that have been bought?
Yes, there's been a few. I mean, if we look domestically, obviously we've had Redrow, which is now Barrett Redrow. Also the Royal Mail owner, International Distribution Services. There was what was the FTSE 100 company, Dark Trace. Britvic was another one, the soft drinks company, and probably most latterly, Aviva made a play for Direct Line, which was initially rebuffed, but it rather looks now as though that will be going through. So, and that's just a selection, as you say. There has, without question, been a pickup in M&A activity.
And what do you think has been the driving force behind that? Is it the fact that the UK market is trading on cheaper valuations compared to its own history? And if you look at the US market, for example, UK shares, whether they're large, mid-cap or small caps, they are a lot cheaper than what you can get across the pond.
Extraordinarily so. I think this time last year we were talking about the fact that the UK market traded on roughly 10.5 times earnings. If you look at the S&P 500, that's more like 21 times earnings. Obviously, there continues to be a great deal of excitement and gravity towards those mega cap technology stocks, which are notable by their absence in the UK. But underlying all of that, as you say, compared to either global markets or on a historic basis, the UK market still remains incredibly cheap.
And while companies, and in particular private equity firms, are circling the UK market and looking to take advantage of cheap valuations to try and get themselves a bit of a bargain, at the same time as that, retail investors are continuing to shy away from the UK market. UK equity fund flows have consistently been in outflow mode since the Brexit vote, and this has carried on again in 2024, despite the fact that a lot of commentators, and particularly UK fund managers, hoping for that to change. It simply hasn't. In terms of M&A activity, we did a really interesting podcast episode a couple of months ago on takeovers with a fund manager called Ken Wotton, who invests in UK smaller companies. He gave really interesting insights into how he approaches potential takeovers for companies that he owns in the funds that he manages. And he explained in that episode how he decides whether to support or vote against a potential deal. So do check out that episode. You can scroll back through our back catalogue on your preferred podcast app. Just going back to UK equity funds being in outflow mode, continuing again in 2024, I think one of the main reasons for this is due to the continued share price successes for the world's biggest technology companies, which are, of course are listed on the US stock market. This now leads me onto the next prediction that you made, Richard, which was that artificial intelligence, AI, will continue to be a dominant theme for investors in 2024. This has certainly been the case. Could you talk our listeners through it?
Yeah, we're in one of those situations where investors are trying to put a concrete valuation on just how much AI may mean from a financial sense. We're already seeing it across all sorts of walks of life at the moment, in business and otherwise. And the thing is that although the valuations are looking particularly rich, there is nothing for investors to compare it to historically. Now, that will bring its own problems at some point because valuations do need to match reality. What's slightly clouded the issue in a positive way, if you're involved in investing in this area, of course, is that most of the mega cap technology stocks and the AI darling at the moment, which of course is Nvidia, has continued to confound expectations. Coming with that, we're not talking about a Chinese market that takes a multi-decade view. We're talking about a US market which takes a quarterly view. And those expectations are going to continue to ramp up each quarter. So for 2025, which is the subject of a separate podcast, of course, we'll be asking the question whether AI is due its day of reckoning or whether it has further to go.
Of course, I think there is the risk that over the short term, there may be a correction at some point for some of those stocks in the Magnificent Seven. As I've mentioned before on the podcast, for investors that are concerned about how concentrated the US stock market is becoming, with those 7 stocks now accounting for around a third of the S&P 500 index, a way to potentially eliminate that concentration risk is through an equally weighted index fund or ETF. So given the fact that there are 500 companies in the S&P 500 index, each share in an equal weighted index would be weighted at 0.2%. And the theory is, if going forward there is a broader set of winners in the US stock market, then an equal weighted approach would likely capitalise more on that rather than the more traditional and common market cap weighted index approach. Now, there's not that many equal weighted index funds or ETFs. However, 2 options on Interactive Investors platform are Invesco S&P 500 Equal Weight ETF and Xtracker's S&P 500 Equal Weight ETF. So, Richard, I've just touched on that there is the risk that there could be a short-term correction at some point for big tech. As you mentioned, the valuations are looking rich. Now, the next prediction you made for 2024 was turbulence. Of course, when it comes to investing, volatility, it's par for the course. However, to me, it seems that in 2024, stock markets were a bit calmer than usual, which is perhaps surprising given there's no shortage of geopolitical tensions. What's your assessment?
I think you're right. And on balance, when we come to the strength of performances, especially for the US markets, that will be proven. That's despite the geopolitical tensions that you mentioned, the overhanging implications which are yet to be fully felt of the UK budget and the uncertainty leading up to the US election. That being said, in early August, and it's one that we struggle to remember now, of course, there had been a spike in not only inflation and recession risks, but also there was this massive unwinding of the carry trade, which particularly affected the Japanese market, which plunged by as much as 13% in one day. By the end of the week, you wouldn't have known it had happened because investors came to the conclusion that in terms of the underlying, not much had actually changed. But certainly if you were expecting a quiet first week of August as we went into the holiday season, the market reminded you it's still very much there.
As you've just mentioned, Richard, there have been periods of volatility, particularly for Japan's stock market in August. But overall, it has seemed to me to be a bit of a calmer year. And despite that, though, gold, which is viewed by some commentators as the ultimate safe haven asset, it's had a really strong year. But rather than it being because of stock market volatility, the reason why gold has performed well this year is because interest rates have started to fall. So interest rates affect the yield on offer from other key safe haven assets, such as bonds issued by the US and UK governments, and that's US and UK government bonds, and in the UK they're known as gilts. Because gold pays no income, it becomes relatively more valuable when interest rates and bond yields fall. And of course, when the opposite plays out, when interest rates rise and bond yields then rise in response, then that is usually a headwind for the gold price. Another factor at play with gold, which was recently pointed out to me by Sebastian Lyon, who's fund manager of Personal Assets, who, for those not familiar, that investment trust is one of a small number of wealth preservation trusts. He pointed out in a recent video interview I recorded with him that central banks are being highly supportive of buying gold since the invasion of Ukraine. And he also pointed out in that interview that Western investors have been selling gold. And due to this, he thinks gold is far from being in a bubble. And you can check out that video on our YouTube channel. Next up in your predictions, Richard, was a potential re-rating for the UK stock market. Could you talk us through the year-to-date returns and whether that re-rating has happened?
Well, at the time of this recording, the FTSE 100 has risen by 7.8% so far this year, and the FTSE 250 by 7.2%. I guess the thing to mention with the FTSE 100 is if you add in the dividend return, you're getting into double figures, which isn't a bad return, to be honest. It just pales in comparison with some of the gains that we've seen from the main US indices. All that being said, and as we've just mentioned, the market does remain undervalued on a comparable basis. The problem is, of course, that we've been saying that the UK market is due a re-rating for some considerable time. It's certainly not going to happen, if it does happen, at the rate that we've seen in the US. And to be fair, the FTSE 100 did actually hit a record high in May of this year. That was at a time leading up to the Japanese thing that we mentioned, where perhaps there was a bit more pessimism and volatility in the market. And obviously the FTSE 100 is seen as something of a defensive play in those circumstances. FTSE 100's not been able to recapture that kind of high. It's still about 1.4% away from the high that we saw in May. But there is certainly scope for further re-rating of the market, potentially pushed along by this M&A thing that we've already mentioned, which could well continue.
We're going to be doing a separate episode looking at predictions and prospects for 2025, which will be published in the new year. But yeah, as you mentioned, Richard, it's for a long time now, a lot of commentators and fund managers have pointed out the unloved UK market is due a re-rating, and at some point, retail investors and overseas investors will return to the UK market. But again, in 2024, that has not happened. And I think if we look back to recording the podcast this time last year, the same arguments are being made that the sweet spot that a lot of commentators say they're finding in the UK market is the more domestically focused mid caps and small caps. I think they've had a good year in 2024 for those indices as a whole. But a lot of commentators are pointing out that there is potentially a lot more to come. However, for that part of the market to thrive, then the economy also needs to be performing well. The next letter on your acronym for 2024, Richard, was R for recession. So we now know that both the US and the UK did not enter a recession. So why did that not happen? And could you talk us through how both economies are currently shaping up?
Yeah, certainly not in the traditional sense. I mean, in the UK, we had a very, very brief and very, very shallow recession. Blink and you miss it before we pulled out of it around the start of the year. But the UK has tended to confound some of the naysayers, certainly not by explosive growth, far from it, but rather it's not been as bad as some had feared. We have other pressures on the UK economy which are now coming into play. Particularly, there's been a lot of noise coming out of the retail and hospitality sectors after the measures announced in the budget, which various companies are now starting to put a monetary value on. Some of the bigger retailers, for example, are saying it will cost them £50 million next year in terms of increased national insurance contributions, the minimum wage, and so on and so forth. So that particular headwind, which was not intended by the government to hit the end consumer, could yet do so if those companies in question decide that the easiest way to replace that or find that money that they need to find for higher wages is by passing on costs. So that could yet be inflationary. But, by the same token, the US had been under a cloud of can the Federal Reserve engineer a soft landing? And we're now talking, getting on for the end of December. There is no sign of any recession in sight. And in fact, the US market has very much stood up to whatever's been thrown at it this year, to the extent that the rate of cuts in terms of interest rates for this year has been slower than expected. And that certainly in 2025, it may slow down further still. And part of the reason for that, of course, is that the economy isn't necessarily in a situation yet where it needs the turbocharge of lower interest rates.
So next up on the acronym was inflation. So Richard, at the start of 2024, you made the point that there was a risk that inflation would remain elevated. And if inflation remains high and interest rates remain at high levels, Both of those against anemic economic growth could have potentially tipped the UK into recessionary territory. So Richard, we're going to speak about inflation in terms of predictions for 2025, but just focusing on 2024, how has inflation played out?
I think it's been mentioned more than once during the year, but in terms of inflation, the battle's been won, but not quite the war. There were also some concerns that if in headline numbers we can get inflation down to 3%, the hardest mile could well be getting that figure down to the target of 2%, which both US and UK central banks have as being the one to aim for. There has been a bit of stickiness in certain parts of inflation. In the US, the consumer, who accounts for around 70% of economic growth there, has continued, largely speaking, to spend. In the UK, of course, it was getting to the situation where inflation was under control, that several rate cuts were expected from the Bank of England. That has slightly changed now for the reasons that we just mentioned in terms of the measures announced in the budget. But I guess the history books will say that 2024 largely was positive for bringing down inflation towards the desired targets.
And next up on the acronym was Technology's Magnificent Seven. So we've already touched on the technology sector and how the S&P 500 index has become more concentrated in these 7 stocks. Richard, do you mind running through, at the time of this recording, which was the 9th of December, how each stock has performed year to date?
Well, at the moment, Microsoft is up by 20%, and that's the inverted commas worst performing of the Magnificent Seven. So just going up the ladder, we're looking at Alphabet, which of course owns Google, up by 26%, Apple by 31%, Amazon by 51%, Tesla by 57%, Meta Platforms, which of course is the Facebook owner, by 80%. And then we get to the darling AI Nvidia stock, which year to date is up by 196%.
Wow, those returns are staggering. I remember in the first quarter this year, there was some commentators saying that they think that this Magnificent Seven might turn into a Fab Four. But I mean, to me, all those share price returns are magnificent for investors that own any or a couple or indeed all of those stocks. Last up on the predictions was yields. So, Richard, this was expected to be a key theme in 2024 due to the fact that for the first time in well over a decade, investors can obtain a decent level of income from the safest part of the bond market, such as UK government bonds, as mentioned earlier, known as gilts, and money market funds. Bond yields remain attractive despite a couple of interest rate cuts taking place in 2024. And given that inflation is now running at just over 2%, investors can now obtain an inflation-beaten return from the safest parts of the bond market. At the time of this recording, you can get just under 5% in terms of a yield on money market funds. And I've been informed by our in-house bond specialists that investors can pick up yield to maturities of just below 4% on direct gilts that are maturing over the next couple of years. Richard, I'll hand the baton over to you now for any further thoughts on yields.
Yeah, I mean, it's obviously partly a question of the investor's attitude to risk. The reason government bonds in the UK are called gilts is because of that attachment to connotations of gold when the old certificates were gilt-edged. And obviously the UK government has never defaulted on its debt, as many other countries have around the world. So they're seeing as minimal to no risk returns. If you compare that with the FTSE 100, for example, the average dividend yield at the moment is 3.6%. That's not dissimilar to the rates that you've just mentioned. You'd probably have to say that purely for the fact that they are equities, they come into the medium risk category. But yes, again, we are constantly seeing that there's so many stable cash generative companies within the FTSE 100, and the UK banks immediately spring to mind, that we could potentially see something of a pop in that particular figure of 3.6% for the FTSE. But I totally agree that the investments that you've mentioned in terms of gilts are certainly a place to continue to look, given where we are with the current inflationary backdrop.
My thanks to Richard, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. If you get a chance, leave us a review or a rating in your podcast app too. And I'd like to take this opportunity to thank all our listeners for tuning in this year, and I hope you have a wonderful festive period. As ever, we love to hear your thoughts on the show and suggestions or questions for future episodes. You can get in touch by emailing otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website at ii.co.uk. And I will see you in the new year, and we'll be returning on the 9th of January. So I'll see you then.